Alright guys, today we're going to talk about how to characterize a market, which is going to be part 3 of the How to Trade Stocks course. To characterize a market means to determine the characteristics or behaviors of the traders engaged in that market. Since a price is the result of a transaction between a buyer and a seller, it is more productive to attempt to understand the unique buying and selling behaviors of these participants than to engage in guru babble about price behavior. If you watch the course video, I know that you know that I know that price behaves as it does because of what traders do. And now you know that I know that you know that I know. While nearly all hobbyists resort to mathematical tinker toys like indicators and formulas, and others look for fanciful shapes, professionals focus on traders and their behavior. When, for example, they see a double top, they don't think, a double top, but rather, sellers ran out of buyers. The first and probably most important step is therefore to think in terms of trader behavior, for it is that, not tinker toys, that moves price. The second step is to begin the characterization process, part of which is cut and dried, and part of which requires a certain sensitivity to behavioral dynamics, particularly the dynamics of fear, which is fear of making the wrong decision, fear of losing money, fear of missing out, fear of holding on too long, fear of not holding long enough, fear of being tricked, fear of being trapped, fear of being blindsided, etc., etc. But regardless of which aspect may appear to be more important at any given time or interval, it is absolutely essential that meticulous records be kept. Without that, you may as well save yourself the time and effort. Trading for a living is not for you. If you're prepared to create and maintain these records, the next step is to observe your market during whatever time of it is of interest. Some items to take note of if, beginning with a day, how does your market behave overnight? Is it flat and listless, or does it provide clues as to where buyers and sellers may be found? If there is a pre-market report coming up, do traders anticipate the results, or do they lie in wait? Are certain levels tested repeatedly, broken, retested? Are prices trending upward or downward? What are the extents and durations of the waves? Does the pace change at any point? If so, in what way? What effect does the change have on price movement? Are any nearby previous levels of supply or demand probed and tested? How? What is the result? Now, at the open, does price spike or plunge, providing no opportunity for entry other than a market order? Is there any opportunity to enter before the open? How high or low do these moves go? How long do they last? What are the qualitative and quantitative differences between the first 10 minutes and the second 10 minutes? The third 10 minutes? How emotional is all this? When does trading settle down? What is the breadth of the opening range? If there is an economic report due out at 10 o'clock, how does price behave in anticipation of it? Do traders appear to wait for it? Is there a line beyond which they will not go? How does it behave after the report is released? How does it react to earnings? How does it react to unanticipated news events? How long is trading active? An hour? 90 minutes? 2 hours? At what point does activity begin to trail off? At what time does it begin to pick up again? 1 o'clock? 2 o'clock? 2:30? How does it behave at the close? How does it behave as it drifts into the evening and the overnight? Does foreign trading become active? Or does the market go to sleep? Looking back on the day, does the market trend with any sort of pattern, or is it seemingly chaotic? If it trends, is it mean reverting? Does it spend more time trending or ranging? If and when it trends, how deep are the retracements? Do the bars overlap a great deal, or are the trending moves clean? Are the ranges wide enough to permit it a retracement tactic, or must one trade reversals at the limits of the range? Are the limits easily definable? Are the trend channels stable enough and long-lasting enough to be tradable? Do they provide easily definable limits, or must one make his decisions according to how far prices traveled from the mean? At what levels do sellers run out of buyers? At what levels are buyers able to force sellers to meet their price? At what levels are most contracts traded? How does price react to those limit levels suggested by auction market theory? You can see there's a lot of questions here to be answered that you would try to gain through characterizing a market. Also, what are the cost-benefit implications of all these trending and ranging movements for scaling in or scaling out? What are the relative risks attending to one or the other? How can one orchestrate scaling in or scaling out tactics to obtain the best cost-benefit ratio while minimizing risk? If you can keep meticulous records and if you are diligent in reviewing these records every day, then you can begin to cobble together a set of strategies and tactics that you hypothesize will exploit the behaviors that you found during your observations. Much of these have been done for you through the CT system course. However, the system does not relieve you of your responsibility for poring over your day's records every evening and preparing a plan of action for the following day. If you do not do this every day, you may as well not trade at all on those days when you just didn't feel like doing the work. You'll not only be throwing away your money, but you'll be setting yourself back. Never forget that professionals are doing all this work. If you're not, and you can't properly characterize your market and anticipate the most probable moves, see the AMT section of the course again, then you're not prepared. If, on the other hand, you are able and willing to maintain these records and review your trades after each and every trading session, there is a possibility, given how few people go through this procedure, that you will find something nobody else sees and take advantage of it while everybody else is standing around wondering what just happened. With regard to prediction versus expectation versus anticipation, hobbyists who don't understand trader behavior, much less how to characterize their markets, call these debates semantics. They see no difference between prediction and anticipation. Those who have gone through the characterization process, however, understand the difference quite well. They understand that AMT, for example, provides the expectation that price will reverse at the upper limit of a trend channel, and one can anticipate, based on his work, that price will do so. Can he predict that price will reach a specific price at the upper limit? No. Can he observe the behavior of other traders to see what they do as price approaches that level and act accordingly even though price begins to stall just ahead of it or overshoots it a bit? Of course. Can he then postulate the level to which price will fall based on principles of AMT? Yes. And when price reaches that level, will onlookers be amazed, convinced that he is a wizard, a genius, a seer? Well, that depends how easily the onlookers are amazed. But none of this has anything to do with precognitive abilities or tea leaves or crystal balls. It's simply a matter of doing the prep. Those who don't do it will understandably be impressed, just as those in the audience who know nothing about magic tricks will be amazed and delighted when Presto pulls a rabbit out of his hat. The average man does not like uncertainties. He is not trained to cope with them. He will try to sweep them under the rug. He will use any device that will make it possible for him to feel more sure, for he is not willing to accept a maybe or an I don't know as an answer. And so he will resort to all kinds of complicated strategies designed to prove that it is either a bull market or a bear market. He will accept almost any kind of nonsense if it's stated with enough assurance. He will buy horoscopes to determine the trend of the market by the position of the planets. If all else fails, he will look for some authority who will relieve him of using his own intelligence by making the either-or decision for him. But he must have a straight, simple answer. Otherwise, it means nothing to him. Do you see how this way of looking at things is out of the line with the facts? Do you see how it leads inevitably to frustration, anxiety, and demoralization? It is asking too much of reality. It is setting up a make-believe world and then crying if the world isn't exactly like the make-believe. Mapping the territory is what characterization is all about. The more distant the trader is from it, the more likely he is to make errors, to miscalculate, to remain out of touch, but when he begins to slow down, to observe, to wonder, to postulate, to test and verify, he begins to understand all the many varied features of the territory, not someone's map of it. At this level, he is prepared to whoop some posterior. Let's take a very quick look at how one can start to characterize markets and their movements. Here we have two different stocks, labeled 1 and 2. At the first letter A on both charts, we can see that the initial downswing on chart 1 travels a greater extent than that of chart 2. At A, price turns upward, stopping at letter B. We can see here that the swing from letter A to B on chart 1 is smaller than that of the swing from letter A to B on chart 2. We can also notice on chart 1 how the swing A to B is held roughly at the midpoint or 50% level of the initial swing, while on chart 2 it traverses greater than 50%. We can then compare letters B, C, and D on both charts, where we notice that these points are held at higher prices on chart 2. Chart 2 appears to be gaining a bit of strength, while chart 1 appears to be holding its initial weakness. Finally, at the red arrow, which marks the same period of time on both charts, chart 1 has traveled nearly twice as much to the downside than chart 2. So all else being equal, which chart would you rather trade? Chart 1 or chart 2? Which looks cleaner? Which offers more profit potential? Which requires less time in the market to bank those profits? This is just a quick example of how one can start to compare and contrast different stocks and find the stocks that might meet more of their objectives from the characterization process. If one needs a certain price range to minimize risk and bank profits, then only those stocks that meet that criteria should be traded. If a stock's swings seem out of control or too volatile to make sense of the chart, then that stock should be avoided at all costs. If a stock respects AMT and is easily tracked via the lines that were discussed in the stock trading course, then that is much more of a reliable stock than the former. This is only one day, of course, but it serves as an example of the kind of thing one looks for during the characterization process. Two words you will hear in the videos to come, and what you should be saying all along your stock trading journey, is character and context. If a stock is of good character, whatever that may be, and however you may define that, and you're able to track this character around context, then you are setting yourself up for great success in trading. Here's a chart of the context using auction market theory for chart 1 in the previous slide. Chart 1 is the prep done prior to the beginning of the session, and chart 2 on this slide is the result of the trading day. We can see once price meets the downtrend line we already have drawn in advance, price plummets rapidly all the way down to the oversold line, also drawn in advance. Now, is this a case of cherry picking, of choosing an exceptional or even unique example in order to prove auction market theory? Arguably, sure. But AMT is, after all, only a theory, not a law like supply and demand. However, by going through the characterization process, especially with AMT in mind, one can determine the probabilities himself for likely moves, their locations, and their extents, then anticipate and exploit those moves. If he figures the probabilities correctly, he will be in better position to profit than his peers who have done none of this. Was this move predicted or anticipated? Think about it. Now remember, chance favors the informed mind. Now, here's an example of a rule set one might develop after having gone through the characterization process. Rule number 1 would be determine the current trend of the market using the weekly chart, then the daily chart. Determine your place in that current trend. Determine the proper timing of your entry into whatever you're trading. Now, A would be find a range, that being either lateral or diagonal, preferably one with easily determinable upper and lower limits. Determine where price is within that range. locate the extremes, which would be called support and resistance. You would then short reversals off the upper limit or buy reversals off the lower limit. When price breaks out of the range, either trade the breakout or wait for and trade the retracement. Track the balances between supply and demand using the lines we talked about in the course. When the trend or stride is broken, exit and wait for a retracement in the opposite direction. Continue until you enter chop, which would be 2 consecutive buy sells or sell buy trades that don't go anywhere and are accompanied by a higher low and a lower high, i.e. not trending. This would also be characterized as another range or hinge type of move. When price exit the chop, which may become a range, like I said, resume trading the trend. If price is trending rather than ranging, locate the upper and lower limits of the trend channel and track the balances between supply and demand until price reaches one of those extremes. Short reversals off the upper limit, buy reversals off the lower limit. Resume tracking the balances between supply and demand until the trend is broken. When the trend or stride is broken, exit and wait for a retracement after the reversal. Continue until you enter chop again, and so on and so forth. When price exits the chop, resume trading the trend. So let's go through an example now, how we can use these rules to actually trade the market. So for rule number 1, very simply, we can see here that the trend of the market is currently up on the weekly chart. Again, rule number 1. For rule number 2, using the daily, we can see price is at its current all-time high and nearing the top of the trend channel overbought line. This location could potentially be a price location to look for a price reversal. Now, yes, it may just bust through the upper limit of the channel and begin an even more severe uptrend, but according to auction market theory, it is more likely to visit at least the median of the channel again, and perhaps even make it to the lower limit of the channel. But we don't have to concern ourselves with making a choice. All we have to do is draw the lines and track the demand and supply imbalances. Here, we zoom in further using a 1-hour bar chart. Yes, the bigger picture implies weakness, but we don't have to make judgments. The demand lines, cyan lines, are broken, which tells us that in this time frame, price is in fact weak and we ought to be looking for a short. We get one in the first retracement at the red dot. The short was exited due to the break in the fanned supply line, or the magenta line, for a small gain. The job then is to wait for a retracement thereafter, regardless of whatever expectation we might have or have had toward weakness. That retracement takes place overnight and the long is entered at the green dot. So now all we're doing is just following the rules listed in the previous slides. This is a zoomed in version of the chart on the previous slide with 2 extra days added in. The same long is still there, but it's easier to see its particular context. When the trading session opens in New York, we had hell-bent for leather to the last swing high and breach it, but failed to breach the next higher one. And we could have exited there if we were to have drawn an extremely tight demand line. But we also have the option to find the halfway point of the rally, which is where the dashed blue line has been drawn. If price can hold there, that rebound suggests strength. But when it fails a second time to make a higher high at the horizontally drawn magenta line, we are entirely justified in exiting the long. The market is not just telling us what to do, it's screaming at us. Even so, we can hold for a break of the demand line just like we're supposed to and exit. Now, this is not a fortune, but it's also not a loss. We then short the first retracement thereafter and ride that down. When the supply line is broken, we can exit, or we can see just how much strength the buyers have. As it turns out, not much. They can't even rally half of the downdraft, the dashed blue line again, so we stay in and see if we can make a lower low. We can, so we fan our supply line out to include the next swing high once price has made a lower low. Price then breaks our new supply line, and again, we have to make a choice. Exit the break and take the money, or wait and see how strong the rally might be. Not unlike Let's Make a Deal, do you want to take the car or door number 2? Here, though, we have 3 choices. Exit at the break of the supply line, exit at the breach of the last swing high, or exit at the breach of the halfway point. For our purposes here, we'll assume that the trader is relaxed and stayed focused and is in due to auction market theory, which suggested that the line of least resistance was down, keeping in mind that even if he had exited, he'd always have the option to get back in. On the next attempt, price just barely breaches the halfway point and immediately retreats. Nonetheless, one could have exited and then re-entered off that failure. When price makes a lower low, the supply line can be fanned again, and when price retraces, the swing high holds well below the halfway point of the immediately preceding downdraft. So, in conclusion, characterizing a market and developing a plan enables the trader to act confidently and decisively when price flashes a big red sign in his face that it's going to travel in a particular direction. If the trade turns out to be worth not much, this same plan gets him out of a potentially losing trade rather than letting him hang. He may even wind up with a small win. More importantly, he will not suffer a loss, at least nothing of the magnitude that he's used to or that he fears. The 3-legged stool here, as I've said, is constructed of a thorough understanding of supply and demand, trending and ranging, and support and resistance. A surprisingly large number of people are absolutely convinced that they possess this understanding when in fact they haven't the least idea what support and resistance and trend and so forth are all about. But even if one has no idea what these 3 fundaments are, much less how to apply them, he can still turn a profit if he knows how to track price using lines, all of which was described in the stock trading course. Unfortunately, quite a few people can't do that either. These people ought to find some other way to trade, or just quit. Otherwise, they'll find themselves trading congestion day after day and getting chopped up in the process with no understanding of what's going on, and blame the method using excuses, another method that's baloney, another scam, more snake oil, blah blah blah. But in the videos to follow, I'll explain how I've set up my trading environment to capture everything I've developed through this characterization process, followed by future videos of actually trading my system.